In this video, we want to talk about some more technical issues with the weighted average cost of capital of the company. So first, let's talk about what factors affect this cost. There are some factors that you cannot control and some that you can control. So the uncontrollable things are the market conditions, the market risk premium itself, and tax rates, right? You can't influence those particular factors. But what the company can control is the capital structure policy, the dividend policy, and the investment policy. In future videos, we will look at these things individually. We're going to look at how does the company look at gathering funds? How do they look at the payout of earnings in the form of dividends? And we're going to look at the investment policy of the company that is essentially looking at capital budgeting projects. So the next thing we want to talk about is what do we do with companies that have different divisions that have different levels of risk? Should the company's weighted average cost of capital be used for every project in the corporation? And the answer is definitely not, since the weighted average cost of capital is the average project undertaken by the firm. So if a company has a very low risk project in a division, they don't want to use the average for the whole company. We throughout our videos have been talking about something referred to as the risk-return relationship. The returns you receive, the cost that you should pay, are related to the riskiness of the thing that you're talking about. So we might need to calculate a divisional cost of capital. So how do we do that? Well, we just have to look at the division as if it was a standalone firm. So we may have to estimate the division's beta, its cost of debt, and the capital structure of the division itself. Now, I'll tell you that this is not the easiest thing to do, and quite frankly, it's very difficult to do from outside the company. But certainly within the company, this is a process that can make or break certain projects within the company. So again, if we use the average and we have some low risk things that are really good to do, we would pass on those really good things because of the risk return relationship, they're not going to provide enough return to get above the company's average cost of financing. So we could use something that they refer to as the pure play method. We need to find several publicly traded companies that look at this project's business, right? So you want to find other companies that look like your division. Find their betas because their betas might be published. And if so, find the average of those companies and utilize that as your division's beta. It's hard to find such companies, right? It's hard to find any two companies that have the exact same kind of business, because companies diversify their projects and their businesses. They have many product lines across a variety of, if you kind of think about Kroger's, right? They have all these different product lines. Why doesn't Kroger just sell meat? Well, it could, but that limits profits, and certainly it puts them in a higher risk level because they have this individual product. If they spread it out over a bunch of different things, they can spread out the variability of their cash flows so that it makes it look a little bit smoother. And of course, we can do the exact same thing. It's the exact same process to use the capital asset pricing model, except now, as you see here, we're going to use the beta for the division. The required return here on debt, that is the cost of debt in the capital structure of the division. In this case, they have a debt ratio of 10%. So when we plug this in, we know what? It's 10% times the cost of debt times 1 minus t. So this is the weighted average after-tax cost of debt. Add that to then, here's our required return on this project's equity in the division. So this company should have a weighted average cost of capital of the division of 14.94%. So think about the projects. If the company is at 10.4, but this division's at 14.9, this is telling us that this division is riskier than the company on average. They've got 20 divisions. This particular company has greater risk on average than the other companies that might be in the overall corporate umbrella, if you would. So again, any projects in this company that are average within that division, they would want to use this particular weighted average cost of capital. So let's continue to talk a little bit more about types of risk, right? There are 3 different types of project risk, and we'll talk about this a little bit later in videos where we talk about capital budgeting. But there's standalone risk, corporate risk, and market risk. And through other videos, we've defined what standalone risk is. Typically, we measure that by standard deviation. It represents an asset standing all by itself. Market risk is that risk that represents the non-diversifiable risk of the portfolio or of the company in general. What we really haven't talked much about is corporate risk. So again, standalone risk is pretty easy to calculate. Market risk, theoretically, that's the best one you would want to use because we assume companies have many projects. So there is a diversification at work inside the company. So market risk theoretically is the best. But creditors and customers, right, they're really most affected by the corporate risk. So corporate risk is also very important. Again, we're not going to discuss that in any great detail here, but we will discuss this later when we talk again about capital budgeting and some of the more complicated issues with evaluating corporate projects. So let's think about this divisional cost of capital for a second. Again, in general, we want to adjust for risk. So we could use just a judgmental scale up and down for individual products. So let's assume we have a divisional cost of capital. That's the average cost of financing for the average project in the division. But what if within that division, we have varying levels of risk of projects? Again, to be fair to those projects so that they get an equal, a fair shake, if you will, as to whether they're good or bad, whether they're going to create value or not, we might need to adjust risk even further. So as they suggest here, we may want to scale the projects up or down based on individual projects. And there are ways that we can do that. And again, I don't want to get into too much detail on projects now because we'll have videos later that will help us assess how you might do this on a judgmental approach. So let's think about a concept for a second called float costs. So there are flotation costs that we have to pay in order to get securities issued, right? The underwriters, the people that help us issue securities, they don't do that for free. So we have something referred to as a flotation cost. And there are flotation costs, whether it be stocks or bonds or preferred stock, there are costs associated with that. In addition, especially if we issue new common stock, sometimes that action itself will have an influence on the stock price. It might drive the price down a little bit because capital markets typically see issuing common stock as a negative sign. Again, I understand that we're kind of getting ahead of some of our later videos that we'll talk about, but essentially we need to understand that there are many influences on stock price, and issuing stock is one of those. So if we think about we want to issue debt, we want to address this issue of flotation cost. Typically, the cost is very low, especially for debt. It's not typically a lot of money to actually pay for these underwriting costs. But the one issue we have to deal with is taxes. Since taxes affect debt and interest expense, we have to incorporate that maybe into our flotation costs. So there's a basic rule that we need to follow. If the flotation costs are greater than 0.25 times the maturity in years, we're going to use something called the constant yield method. So essentially what that means is the flotation cost is exactly what it says as a percent of the par value or the market price of the stock. However, if the flotation cost is less, we're going to use something called the linear allocation method, which looks at the impact of taxes over time, and we associate that or incorporate that into the formula. So let's look first at the constant yield method. In this case, if we have a 30-year debt and the flotation cost is 8%, 25% of 30 is 7.5%. So the flotation cost of 8 greater than that, so we use the constant yield method. So if we go back up here, I'm going to go back to a previous slide. We have a place here to put flotation costs. Flotation costs would be incorporated right here. So you would put in here whatever you thought the flotation costs were, but of course, that would depend on this relationship. So in this case, you see that we just use the 8%. So the flotation cost is the difference between the market price and you subtract out the flotation cost. So that means it's $80. So in this case, $80 would be the flotation cost that you would incorporate. That would then change the yield, obviously, and that would increase the cost of this 10.9. Multiply that by the tax rate. Now we're at 6.5% for the cost on this particular debt. If the flotation cost was less, 2%, 25% of 30, again, that's 7.5, it's less. So now what we have to do is adjust the cost for taxes. So the dollar flotation cost, 2% of 1,000, is $20. You divide that by the number of years, or by the per coupon payment, that is. So in this case, we have annual interest. 20 divided by 30 means that it's 0.667 is the allocation of the coupon payment or the flotation cost per coupon payment. So every coupon payment, roughly, you're going to have to deduct 67 cents to cover flotation cost. But that's, since you're deducting it, that means you get a tax savings. So you actually save 27 cents every time you make a coupon payment. So now we have to incorporate that into our plan here. So again, the actual cost, 0.2667, they've rounded that off to 0.02 cents. So it's it's $980. That's the proceeds. You just deduct that. So flotation cost is 20, but you then have to do this calculation to the coupon. So the coupon is adjusted by 26 cents. So instead of being up here where the coupon was 10%, the coupon down here is going to be $59.73. So again, plug that into now the coupon. We end up with 6.12% is the actual yield for this particular bond. So you can see that the cost is different. 6.5% is this cost using the constant yield method. 6.12 is the difference using the allocation method. Again, granted, it's not that much different. Of course, this all depends on the tax code. It depends on the coupon, right? It depends on time, right? So the importance of this will be different depending on the variation of the variables inside this calculation. So what about flotation costs? Again, really they depend on the risk of the company. So the riskier the company, the greater the flotation cost might be. For bonds, it's typically pretty low. Frequently, they just ignore flotation costs when you calculate the weighted average cost of capital. Now, what that does, though, is that reduces the cost of capital that you're looking at. So you have, if you have a project that's real close to the weighted average cost of capital as far as their returns, you may want to look twice, because the number you're calculating, since you've ignored a cost, right? Since you've ignored a cost, we have to make sure that we make the right choices when we're choosing projects. So what kind of mistakes can we make when we are looking at cost of capital? We have to remember that we want to look at current costs rather than historical costs, right? So when you estimate the cost of debt, we don't want to use the coupon rate of existing debt. We got to look at future debt, the debt we're going to issue. We need to understand something about the market risk premium for the CAPM approach, right? Well, we don't want to mix numbers. You don't want to use the historical common stock return, which we've talked, is roughly around 11.5, 11.7%. You don't want to compare that to the current risk-free rate. So you want to always be using historical versus historical, or current versus current. So using the current risk-free rate and subtracting that from the historical, this 2.2% is not an appropriate number to use. We've talked about estimating weights. You want to use market weights, especially for equity. If you don't know the market value of debt, which we frequently don't, you want to use the book value of debt. It's usually pretty close to the book value, and the market value usually pretty close, except for some very short-term types of things. We do not include short-term things. Weighted average cost of capital is a long-term cost of financing. These costs of accounts payable, accruals, etc., they have costs, but those costs are incorporated into the project cash flows when we analyze projects. So they are not ignored. We're not going to ignore them, but we're not going to include it here in the cost of financing, quite frankly, because the costs for these is frequently more opportunity cost than actual cost. So there are many things that can play games, if you will, with these numbers. The best thing we do when we calculate the number, you just have to recognize that is the number today. As soon as you calculate it, because the markets change 24/7 every day, the number itself can adjust from day to day. So again, that's the end of our videos. We had 3 videos here on cost of financing, and it's a very critical number for companies to understand. This is the benchmark. It's the average benchmark of the company, that they should only do projects that are going to give them a higher return than what it costs to finance them. And it's really not intuitive how that all works. But if you think about the rate of return of a project, it incorporates all the costs of doing the project. So that's the rate of return of the project, not including financing. And we compare that rate of return to this number, which represents the cost of financing. So all the costs are going to be incorporated. They're just done 2 different times. Once in predicting cash flows, once in predicting the source of financing. So that's the end of the video. Hope you liked it. See you.